Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 9 straight years and running, celebrating more than 31 years, helping North Central Florida proactive savers and investors formulate the plans to achieve their goals. And John, grateful to have you here, founder and CEO of GulfCoast Financial Services, John Kuykendall, our resource for the information and guidance on how to make more informed decisions. And John, more informed people tend to make better decisions with their money. So glad to have you here.
Well, thank you, Peter. It's great to be here. I hope today that the listeners will get some good information. I think we've got a great program today. It's very timely. With the volatility we've been talking about in the market in the last couple of shows and just the volatility we've seen. Peter, it's proven that people with financial advisors actually do better in the market than those that don't have an advisor. And I think the problem is that the Americans are emotional. And we've seen a lot of volatility, and people, they want to make money, but they don't want to lose money. It's kind of like the lady that told me she wanted to buy a stock, and she wanted to make 10%, but she didn't want to lose anything.
Right.
Well, that'd be great if we could do it, but we can't do it. But we're like that. And so we overreact during market conditions. And I think one of the big things for us as advisors is to give that steady, calm guidance and help people navigate through all the volatility that we've seen in this market.
Yeah, indeed. A voice of reason at the very least, so to speak. And I actually think it's at least twofold. One is, John, as an advisor, you've seen the financial world many, many times over through multiple situations, whereas any individual is only going to see it through their own set of circumstances and their own experiences. So that additional level of experience and knowing different situations probably certainly gives some advantage in being able to navigate some of the questions and the risks and issues and opportunities. And then that emotional aspect that you spoke of. The Dow Institute is a research firm that has done a study of investor behavior and investor returns for at least the last 30 years, have shown that average investors underperform generally because they do tend to react emotionally. And so I know a large part of your job is formulating the plan and then reassuring as we move through conditions, which will certainly change over time and cycle through different markets and economies, that the plan is still in alignment and that we don't deviate from it just because of those emotional reasons.
Well, that's right, Peter. One of the things that we try to do here is we can't afford as seniors, when we're in the distribution phase of our life, we can't afford to ride the market down 30 or 40% if that's the only source of income that we have coming in as our allocation bucket. And so I think that's why the show today is so timely as we talk about annuities and how they work and the different types, and how we can structure annuities so that they really benefit us. Annuities have a bad reputation. I think, in the past, Peter, there has been some abuse of annuities and how they were sold and how much the representative made, because we get paid a commission on those. Now we have to show that, and we're not afraid to, that when we sell an annuity, we get paid a commission from the insurance company. But 100 cents of the consumer's dollar is invested from day one. So that, it gives them a big benefit. And I think that annuities have a place. It just depends on the circumstances, your individual circumstances, and what we are trying to do during retirement.
Yeah, I think they've been widely debated and much maligned or made out to be the solve all best thing since sliced bread. And John, with almost as with anything in life, neither of those extremes is always going to be the case. It's just one of the tools in your quiver that you have access to. So why don't we talk about it? And maybe in the context of the discussion, there are certainly other options out there, ladies and gentlemen, but today's conversation going to focus a little bit on the debate about annuities and their merits and their values, their advantages and disadvantages. So, John, getting into a discussion about annuities, we probably should start by defining what they are and what they can do or what they do well.
Well, annuities, what they do well is they can provide you predictable income. Income annuities are going to give you a set amount of income for life. And so that's something that in retirement, we found out that we really need is because we don't have that retirement plan, that defined benefit retirement plan that pays us a check every month. So it's nice to be able to budget and know that on the first of the month, I've got so much money coming in. Some of those will also, increase their payments over time to keep up with inflation, because that's a big one. I read this morning that in 1973, you know what the average Social Security check was, Peter?
Probably significantly less than it is today, comparably. Maybe about $1,000 or less, even, John.
$166. In 1973, we didn't have 401k, so there was 47% of the companies had defined benefit plans. The average payment on a defined benefit plan or your pension was $177. Now, if we move forward, our average Social Security check today is $1,000. In 2021 was $1,000, and your pension was up to $1,000. So we've gone from $244 of spendable income in retirement in 1973 to 2021, where we had $1,475. I think that's a great example of inflation and how much more money it's going to cost you during your retirement. America has more people over the age of 100 than any country in the world. I forgot the number, but there's a large number of people that are turning 100 every day. They had a big thing on the TV about it this morning. It's a big deal now. And so as we live longer, we're going to need a lot more money, Peter. I mean, this just proves it. Inflation is going to eat up, and the annuities will help us keep up with inflation with an increased income for those that are prepared that way. But also, they will give us a predictable income so that we don't have to hit our allocation bucket, our growth bucket during times when the market's down.
Well, John, and with the decline of pensions and with the difficulties facing Social Security, those traditional streams of retirement income are more in doubt than ever before or absent altogether. And yet still, with the inception of the 401k, this generation has saved and accumulated far more personal wealth than previous generations, but it does not seem to be equating to more retirement security or confidence. The saying of the last generation was, we are on a fixed income, whereas the worry of this generation is, will we run out of money?
Well, I think, the last generation, they didn't have a lot of money. They didn't need a lot of money. They didn't have pensions. They had small Social Security checks. Because of the market and the way things are, our, as I said before, our needs have increased, even though our wants have increased. So we cost more. We spend a lot more money now than we did. Like when I first got married, we didn't have internet, we didn't have cell phones, we didn't have those extra bills that we have every month now that we consider to be necessities.
Right. It's not just the inflation on the items that we still purchase, John. It's all of the new line items in the budget that we have to account for. And that's why adding another healthy source of reliable, consistent income is something that seems appealing to many as we transition into and make our way through retirement.
Well, I think that's right, Peter, because if we look at the fact that, those are my fixed monthly bills, and I have a certain amount I have to pay every month. If I'm relying on the market to give me that, I'm going to run out of money. We've talked about that in prior shows, the sequence of return, where I'm taking money and pulling it down in a down market. I'm going to be crashing my portfolio sooner than if I didn't have to take that money out in a down market and I could let my portfolio, replenish before I had to hit it. And if I use my growth bucket for those things that I want to do during retirement and the actual things that we haven't accounted for, new roof, new car, things like that. So it just makes a big difference to have that predictable, sustainable income coming into your portfolio. And annuities are one way we can do that. They're also, tax deferred. We're not going to pay interest on the gain and our taxes on the gain until we take the money out. And so as we take it out, we pay taxes. The other thing in Florida, especially, they're suit protected. People can't sue and get your annuity. So they're kind of like an IRA in that case, an individual retirement account, in that in Florida, by the way that the law is structured, you can't go to court and get my annuity from me. So there are just a lot of advantages for seniors to have annuity. Now, there are different kinds of annuities. And so when we talk about predictable, sustainable income, we're talking about an income annuity. It could be a variable annuity, or it could be a fixed indexed annuity, or it could just be a premium annuity where I'm giving the insurance company a lump sum and they're giving me income day one for the rest of my life or for a period certain.
And John, I think this is part of the debate on the merits, the values, or the downside of annuities. Is that there are many different kinds, and understanding the different kinds and what they do, and then the bells and whistles and the inner workings and features adds yet another level of complexity there. And again, why it probably benefits individuals to consult with a well-versed professional that is not beholden to just one tool or one product or one company's line.
Well, that's true. And because they are complex, they're as complex as any investment, a stock or a mutual fund, but there are some complexities. And I'm not saying, Peter, there isn't abuse. You and I read every day of advisors, both insurance salesmen and security people, who have abused the switch and bait and switch rule and are, cashing these things in order to get more commission. And so people have to be aware of what they're getting. They have to understand them to the point that they understand why they're doing what they're doing. If you have an existing one, then somebody should explain to you why you need to surrender for a different annuity, and it should be a decent reason. Just because, first of all, the insurance company doesn't owe you interest. I mean, I've never seen a place where an insurance company owed you back interest, and if you took out another annuity, they were going to give you that annuity. All that is a bonus on the annuity that every insurance company offers at some point. So you need to know why you're doing what. And I know over my career, I've seen a lot of different excuses that did make a lot of sense as to why people have done different things.
But what happens on day one, that carrot on the string, John, in something that is typically intended for a long-term period or even lifetime, may not be the most important factor. So absolutely something to be aware of and wary of is the incentive of that upfront bonus may not be the most important factor in an annuity consideration, ladies and gentlemen. But what can be important, John, is protecting our principal and protecting our income, especially in the midst of market volatility and market losses of 10, 15, 20, 25% or more, where we don't want our principal impacted. We want to preserve and protect. We don't want our income to be diminished. We don't want to lock in losses, and we want to continue to live a sustainable, confident retirement.
That's right, Peter. We need to know that check's going to come now. Your principal is protected, and it's based on an implied guarantee from the insurance company. The insurance company is saying we're going to pay you every month, and there are backups to them and insurance and other things that help us make sure that these insurance companies can pay. But we need to be aware that we are looking at a whole different variety of annuities. Some have fees, some don't have fees, some give a fixed interest rate, some are set for a fixed period. But every annuity that's out there, except for the one that we're surrendering our money, which is a single premium immediate annuity, they all have surrender periods, Peter. During that surrender period, you are penalized if you take your money. And so you need to be aware of the surrender period, whether it's 5, 7, 10 years, what that's going to do. And the reason that we have these is to pay the insurance company back for the commissions they're paying out and the marketing they're doing to get your money in their company. But also, like you said, these are long-term investments. And so the surrender period shouldn't be a problem if we've got the kind of annuity that we want and it's doing what we need it to do.
That surrender period, John, also a way to protect each individual investor or purchaser of an annuity from a situation such as what we saw with the banking industry earlier this year, right? The thing about banks is everybody can theoretically come and pull all of their money out all at once, whereas the insurance industry through annuities in that time period commitment and the surrender charge has specifically designed and structured the architecture of the products to prevent that.
That's right. And the insurance companies have invested that money. They've taken either bought long-term securities or gone into real estate or done something else so that they can make the money to pay you the income and pay you and give you some kind of gain. So, that money has been allocated by them. And if it was a free surrender period, then they could never make enough money to pay us enough money to make it worth our while to be in an annuity. So we have to understand why the insurance company does what they do. It certainly gives them the stability, and we want that. We want the insurance company to be stable because that helps us with our income. It helps us get paid each and every month if we have an income rider.
Well, John, you mentioned it, that all investment products are complicated. It's been said that annuities are so complicated. Mutual funds are generally pretty complicated. Challenge anybody to explain fully everything that's in the prospectus of that mutual fund. But what's not so complicated about a mutual fund is if I want to get out, generally I can do so at the end of the next business day, whatever the amount might be. Now that can fluctuate, whereas with an annuity, getting out of it and untangling can take some time. There can be some stipulations or limitations. So what we want to know is when we expect to get out of it and what we expect to get out of it before we ever get in.
Yeah, Peter, you're right, Peter. These are long-term investments and we need to know what we're going to get out of them. And, while annuities have a kind of a caveat of having high fees, they really don't. Some of the annuities have no fees at all. Other fees you're paying for a rider. Variable annuities, you're paying a little bit more in fees because you have administration mortality and you also have the fee for the mutual funds because a variable annuity is actually invested in the market based on your allocation. And you can lose your principal in a variable annuity. The fixed indexed annuities and the fixed annuities, you can't lose your principal because of the guarantee from the insurance company.
John, one of the things that can have some specific situations where it can be advantageous, in fact, there's a section of the tax code that allows for it, but also can be kind of a warning flag to look out for when replacing or exchanging one annuity for the next. When is the right time and place to consider this, or what are some of those warning flags to watch out for if we are considering it?
Well, first of all, Peter, you got to remember an annuity is like an IRA. So if I put non-qualified, if I put my after-tax money into an annuity, If I take it out to 59.5, I'm subject to the 10% penalty rule. So I have to be careful there that at the right age that I'm doing this, or I'm doing it with qualified money or doing it for the right reason. Those are just, it's some of the things that happen that we need to be aware of. But, you know, if an annuity company, as they change the caps and floors and all the other things that the components of annuity, we need to look at that. And if the annuity becomes outdated and the insurance company isn't watching it and managing it, then we need to take a look at exchanging it. And in some cases, we need to look at, you know, the insurance company itself and its rating and how's it doing financially. We may end up in a situation where we want to get out of a lower rated insurance company and go in a higher rated.
Pros, cons, benefits, disadvantages. Every financial product has both sides of it. You need to understand the features and benefits of anything that you are considering putting some of your hard-earned money, your life savings into. But John, annuities, more and more, I think that as we are seeing this transition into retirement, many are finding what they offer particularly attractive. And with the increased interest rates and the payout features of annuity, the protection of income, that also many are finding attractive.
Well, that's true, Peter. And, you know, some of the 401ks now actually offer annuity options. So it's not like annuities have that stigma they used to have. They're finally becoming accepted, and the government more and more has accepted them. So there are some options in some of the 401ks for annuities because of the lifetime income.
Would it be better, John, to go with that option inside of a 401k or possibly shop outside of the 401k to see if there are better options?
Well, I would rather shop outside of the 401k because in the 401k, I'm only offered one option, whereas outside of the 401k, I'm offered numerous options and different benefits and different investment options. So for me personally, I would go outside and I would keep my 401k and always match the match. So if my match is 5, I always want to put 5 up. But, nowadays we need to look at a lot of different things, Peter. We got to look at Roth IRAs. We have to look at Roth 401ks. We've got to look at all kinds of options so that we can get more money in retirement. Retirement is here. Taxes are changing. We know that. Taxes are going to increase. We get a whole new set of tax laws in first of 2026. Or maybe these will be extended, but I don't believe that. So, we just there's a lot to worry about in retirement. The least of them that we want our people at GulfCoast Financial to worry about is running out of money.
Well, ladies and gentlemen, that starts with having a plan put together. And at GulfCoast Financial Services, they put together that written, financially focused income plan for you as part of their initial services, the complimentary review, the strategy session, the risk and investment analysis, the Social Security optimization. All of that is part of that planning process. If you'd like to take advantage, pick up the phone, give a call, 386-755-9018, 386-755-9018. If you've heard about, been wondering about, want to know the buzz about annuities, or maybe even are already considering one and want to make sure that you are making good considerations for your financial future, informed considerations, pick up the phone and give GulfCoast Financial Services a call. They're happy to walk you through that as well. They, of course, have access to many of the different choices and options within the spectrum of the financial world, not just one solution for every problem. That is going to be certainly a benefit with any advisor that you talk to, and why the team there at GulfCoast Financial Services continues to serve so many and be named continually best of the best in financial services by the readers of the Lake City Reporter 9 straight years and running. So again, if you would like to get that financially focused written retirement income plan, pick up the phone, give a call, 386-755-9018. John, always a pleasure to have you on the program. Thank you for the discussion and breakdown of annuities today.
Thank you, Peter. It's great to be here. I hope we gave some good advice to our listeners.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.